Good afternoon, everybody. Welcome to another live and interactive webinar hosted by RJS Wealth and Medoris. Joining me today, we have two fantastic young ladies, senior accountants from RJS CAT and senior accountant from Medoris Internet, and we'll get to those lovely ladies very shortly. For those of you who are joining us for the first time, and a little bit of background about our businesses. 15 locations across Australia, 200 plus staff and over 55,000 happy clients. How do we continue to do that? How do we continue to grow and engage with our teams and our clients? Webinars like this. So welcome for those of you, and welcome back to our current client bases. The other thing we do very, very well for over 35 years, which has won us an enormous amount of awards, but most importantly, the gratitude of many of our clients. And thank you to those clients who continue to work with us. We surround you with professionals. This is what we call the service circle, and we believe it makes the difference to our client base to ensure you have a full-scale advice discussion. It takes away the blinkers and we have a wider discussion. Today, we're talking about what the successful, mostly financially successful people do at tax time. The first thing they do is take the blinkers off and have a wider discussion. The second thing they do is start to understand that tax time is more than just minimising tax. Doesn't mean we don't minimise tax, but it means we have a wider discussion. And joining me today, as I said before, there's a fantastic Kat and Annette. Before we get to that, one last thing which we always have to cover, a disclaimer. Today may sound like it really does align with everyone online. That's because you helped build it with your questions and queries and with the experience of our team. Today is not personal advice. It's very general in its nature. When and if things pop up, please put the questions on the chat down the bottom of the screen. We're very happy to answer those. But most importantly, reach out to your RJS professional or your Medoris professional so you can start to get some very personal and strategic advice to address your questions and concerns. We'll do our very best today, but it is general in its nature. Okay, thank you, Stella. Let's introduce our fantastic experts today in Annette and Kat. Welcome, ladies. Lovely to see you all.
Thank you.
Thank you. Excellent. Very exciting. Okay, let's get stuck into our agenda, team. I spoke a little bit about in our introduction tax time is certainly more than just tax planning and minimising tax. Annette, what's your thoughts on that?
I think with the financial opportunities, as the introduction said, it's not just about end of year, it's throughout the whole year. So when you're thinking about tax, thinking about your financial opportunities, it needs to be top of mind all of the time, not just when it's 5 days out from the end of the financial year.
You're getting those phone calls now, are you, Annette? That's excellent. Kat, what about you? I know Kat does a lot of work in RJS with our business clients, but also our individuals. Do you see any correlations between what you talk with businesses and individuals as well in preparing for tax time?
Yeah, I suppose, especially the way the world is going these days is, we're more mindful of our own wealth and finances. And I suppose a lot of the talk around individuals now is like, and it said it's not just about your tax return at the end of the year. That's not what we're only here for. And it's growing your own personal wealth. So personal budgeting as well. We were mentioning before that I even have a spreadsheet of pretty much every cent that happens in my life. So I practice what I preach, guys. But it really helps. It really helps achieve personal goals. And I mean, that's what it is at the end of the day, isn't it? We earn money to achieve goals, not to figure out what deductions we can have.
Absolutely, absolutely. Our MD Peter Schreier, he's got a quote that I love: "Success doesn't come to you; you have to go to it." And I think this is one part of it that we're going to talk about today. The agenda is very simple, ladies and gentlemen. 3 real key points. What are the financial opportunities that are available before June 30? So some very specific tax strategies, which we'll go through very shortly. Then we're going to start to expand the discussion and talk about what the financially successful do to prepare for tax time. And as both Kat and Annette have shared, they do that well before tax time. And in fact, it's a strategic plan. It's part of a whole of life plan. It's about reaching personal and financial goals. And then finally, what questions do they ask at tax time? And we've had a chat about this well before today's agenda. And I know there's some curly ones there, but they really do come in and push our team for more, which is fantastic. So let's get stuck into the agenda today, ladies and gents. Thank you, Stella. First off, we're going to start to address some tax strategies. We'll go through a couple of slides to address these. One that we see very often, Kat and Annette, is did you contribute to super? It's a very easy one to address. We know that it can save some tax. Could I get Kat just to talk about this a little bit? What do we need to be aware of when we're considering our super contributions? And as you both told me prior to today, you know, those barbecue discussions can lead people down the wrong path in this very simple and often spoken about strategy.
Yeah, and I think if you've come to one of the webinars beforehand, we do often bring up the barbecue discussions, and I think it's probably the accountant's most dreaded conversation, isn't it? Because you know, we are professionals in what we do, just as what you guys are. You know, so you know, your old Uncle Bob might be saying his circumstance, but please chat to your accountant about your circumstance. So when it comes to this strategy in particular, I think there's just Stella, if you could just go to the next little bit, there should be some text. Perfect, thank you. So if you are thinking about putting some money towards super, it can be tax deductible. Again, I'm saying can because all different circumstances, are different, and you need to make sure you do it in a certain way. The contribution cap is 25,000, but that does include, and I'm going to say 9.5%. You know, the SGC that your employer pays on your behalf. That is included in that 25,000. So if at the end of the year you put in 25,000 and you have a wage and salary job, you're going to be over that cap. So it's really, really important to make sure you look at your transactions for the year and your super fund before you make that contribution, and of course talk to your accountant.
Yeah. So just for those of you at home, SGC is super guaranteed contribution, and it is different for every person, Kat, based on their wage?
Well, yes. So it's at the moment it's 9.5% on your gross wage, depending on obviously your how your salary package, if you put more in or whatever. Some jobs can have, is it 12.5% that the government jobs have, the lucky people, and it is going up this year, I think, to 10%. So that's nodding. So yeah, so a bit rusty with that one. So yeah, so it is going up. So from 1st of July, we're going to be costing our employers a little bit more money, but hey, they don't mind that because we're obviously valuable to their workforce. So yeah, we will be getting a bit more for our buck this coming year. I think they're slowly bringing it up to the 12%, aren't they? Yeah. So it will slowly increase in the next couple of years till we get the 12% that's contributed by your employer. Absolutely.
Super is a fantastic place to put your hard-earned cash. It's a great tax savings plan. It's also an essential wealth building plan. So I would encourage everybody to keep an eye on their super and really engage with the professionals. A question I often ask people, when you're retiring, you're going to have, well, many Australians have hundreds and hundreds of thousands of dollars in super. And if they haven't looked at it, the question is, would you give someone 100 grand or 200 grand or 500 grand today and not ask them what they're going to do with it for the next 10, 15, 20, 30 years? The answer is always, I want to be involved. So get involved with your super for a tax reason and for a wealth reason as well. Annette, did you want to move on to the next slide, or are you happy to, did you want to cover something here?
Yeah, I just think with the caps, as Kat mentioned, you've got to take into consideration your personal circumstances, and that is also maybe where you are in life. So for some people making these contributions when they're early on in their working life may not be the best strategy, but these are all ones that can be looked at and addressed and may be beneficial if you go and see your accountant about your circumstances. So it is definitely a good tax tool, but once again, it's your circumstances that will determine whether this is right for you or not. So speak to your accountant.
Yeah, absolutely. I think this in the next slide too, we're covering carry forward rules. The next slide about when and how much you paid is really very much a personal situation, needs advice.
Yeah. Yeah, it does. I had a discussion recently where we were talking about a person's, they were a sole trader and they're in a particular stage of their life, and they've only just decided that they need to look at what their super is, and saw what their balance was and started panicking a little bit. Luckily, based on their particular tax position, we can now take advantage of these carry forward unused caps from prior years to bulk up their super. So it's always worthwhile to have a look at these things, and the carry forward unused concessional caps that have been brought in is a really good thing to look at for your, not only your retirement, but also your tax position in the current years, or if you have a certain event that's created more income for you for that year.
Yeah, so that allows us to look at wealth creation, cash flow, and tax minimisation in that one strategy.
Yeah.
Great. So essential. When do you want people starting thinking about that?
Today.
Paul,
you've had a great saying that you've always spoken about in relation to super. If you want to pass that on, the statistic that if you start looking at these things at a certain age, the better you'll be.
Oh, yes. Melbourne University did a study very recently that if you start even thinking about your superannuation, so thinking isn't actually doing anything, but if you think about superannuation 10 years in advance, you will be 3 times wealthier. Melbourne University released that study a couple of years ago. It was a great study because we're a bit off track, but it did go on to think once you start to think about something, you start to action, and then you start to seek professional advice, which is why people who think and talk about their superannuation and proactive about it end up 3 times better off. So it's a great little stat. Thanks for reminding me of that one, Annette. Okay, let's move on to our next strategies, ladies, please. Thanks, Stella. And again, thank you. And one more. I think, yeah, that's it. Okay, some tax strategies. Sorry, if we go back, tax strategies for individuals. So now we're looking at more individual strategies that we can get better cash flow and better offsets. So claim an offset for your spousal contributions. Annette, could you address this slide, please?
Yeah, so this is something if you have a spouse that is a low income earner or a no income earner, you can contribute to their super. Making a contribution to their super is a really good way to grow their retirement savings, and you can reduce your tax at the same time. So, if you have a spouse that has stopped earning, they've taken time off to raise kids or look after a loved one, their retirement savings aren't building. So you can make an after-tax contribution. So this is not a tax contribution where you're going to claim a deduction for it, but an after-tax contribution, and you're helping them grow your super. At the same time, you're, depending on how much they earn, you would be eligible for a tax offset. So this is an offset against your tax payable position of up to 540. Now, the 540 depends on what your spouse is earning. So you get a full rebate if they earn under 37,000, and then that phases out to after they earn 40,000 or over. And it's basically the first $3,000 you contribute to your spouse's super. You get 18% of that contribution, which is a maximum of 540. So anything over 3,000 you won't receive a tax offset for, but it is worthwhile to help your spouse and also to get an offset in your tax.
Fantastic. Kate, did you want to add anything to this strategy?
No, I think Annette covered that all off pretty well.
Perfect. Okay, we can move on to the next one then. Government co-contributions. Applies to low income earners, can make a difference to the contribution. But Kate, did you want to address that one?
Co-contributions. I think the slide pretty much covers that as well. It is what it is. So low income earners, you can get a little bit of an extra boost from the government if you put in money into your super fund. So that isn't included in that 9.5% SGC that your employer pays. It is extra contributions that you put in. The government, depending on your income, as you can see on the slide, it will co-contribute up to $500.
Yeah, and if your spouse has, if we talk about going back to the previous offset, if your spouse has put in after-tax contributions into your super, that doesn't get included in this calculation when the government makes the co-contribution to your super.
Okay, so what's the implications of that, Annette?
It can be on top of your spouse makes a contribution to your fund. You also make a contribution to your own fund. They're both after-tax contributions. The contribution from your spouse isn't included in this calculation, so it doesn't affect your ability to get the full $500 co-contribution from the government.
Yeah.
So you can do the two strategies, your spouse and yourself, and both the offset and the co-contribution amount isn't affected.
Yeah. Now, since this is after tax, all three of us spoke earlier around, tax strategies are great. We need to be aware of the impact into their personal life as well. Since this is after tax and an additional contribution, should people also be aware that they need to take into account not just going for a tax saving when you've got things that you need to be paying for, like a mortgage, a debt, credit cards, and meeting other lifestyle goals. So what should people be looking for in here? We don't want people just jumping just to save tax, but putting other parts of their personal financial situation at risk. Kat, you spoke a lot about this before we got on.
Yeah, I suppose, so a lot of people, their focus is on how to minimize tax. You pay tax based on your earnings. So you're not going to pay, our job is obviously to make sure that we minimize the amount of tax and you only pay what you have to pay. But the amount that you have to pay is based on, your wealth, I suppose. And cash is king. That's for businesses and for individuals. So, yes, this is a good tax strategy, but it may not be good for you. So say, for example, you are, in that income earning phase and, you're quite young, you haven't got a house yet, or you have a house, but the mortgage is huge, or you're about to have kids, or you've got young kids, your money might be better spent elsewhere. And that, even if it's a case of, you want it to, accumulate, there may be different types of investments that would be better suited to you. So that's where chatting to a financial planner, obviously, and your accountant. The accountant usually can help you up to a certain stage and then refer you on to a financial planner to see where is the best place for your money to go, which also may be tax deductible or assessed for your taxable income as well.
Yeah, absolutely. I couldn't agree more. We speak a lot about, spending $1 to save 30 cents versus using $1 to make money. So I think the key message there is ask more questions and speak more, understand the implications of either one. Donate to a travel organisation. I think that's self-explanatory and something that is very good to do. Just make sure they've got a gift register.
Sorry, I will just say one thing on that point, because I know it is very self-explanatory, but the little dot point there is, and you were just about to say, sorry, I did cut you off. That's the hard thing about webinars. I do apologise. It does have to be DGR, so it has to be on a certain register. The GoFundMe pages, everyone is popular and mad at donating to them these days. And they get angry at the accountants who say, that's not tax deductible, but unfortunately, it's not a recognised charity because you could be, contributing to your next door neighbour's fun run, So, you have to make sure that it is a registered charity.
Yeah. And I'll just add to that quickly. It has to be a gift. It has to be a donation. There can't be something reciprocated. So, raffles or art union tickets, even if they're with charities, if that's what you're purchasing, it's not a deduction that you can, a donation that you can claim a deduction for.
Yeah, absolutely. Lots of rules around that one. So you can cut me off any time, Kat. I think the next one is something we're going to have a bit more detailed conversation. We hear clients talking about a lot. Salary sacrifice is a strategy. We've all seen clients talk to us about this, where they've been given information from HR or pay clerks or friends. This is actually more technical and more complicated, and can have bigger repercussions than just simply using money in a different way. So I'll hand over to you, Annette, to open the batting on this. We did speak a lot about this prior, but I'll get you to talk about it initially, please.
So salary sacrifice arrangements depend on who your employer is. It also is basically a situation where your salary is split into both income and benefits. So you'll receive part of your remuneration package as wages, and then the other part of that will be for benefits such as computers, laptops, subscriptions. And what that does is, the benefit of salary sacrifice is that it's reducing your gross wages because your part of your remuneration has been reduced, so the wages are less, and that means that your taxable income is less, and so you have lower tax to pay. With these arrangements, it really depends on the employer. There are various types of benefits which then can create other issues in the sense of fringe benefits, tax, etc. So when it comes to these things, I always believe it's a process where you've got to sit down and run through the figures and get advice in relation to what your employer offers, what you can do, and how it's going to affect you on a personal level, both with your cash that's coming through, so your actual wages that you're receiving, and your benefits.
Yeah, good point. Good point. Just before I pass to Kat, there's a question come through, and sorry, they didn't give their name. So, is there a limit you can salary sacrifice?
Yeah, so this is again dependent on, as Annette said, your employer, but also your industry. I must admit, I'm a little bit dirty on salary sacrifices with the industries. So certain industries can salary sacrifice up to a substantial amount. I'm not going to say amounts because they can change and industries can be different. But a lot of industries are capped basically on, for example, the ones that are up on the screen. So I'll use accountants as an example. Usually it's just, your laptops and those kind of tools of trade that we can deduct and through salary sacrifice. So usually employers who can do especially substantially more, they have a salary packaging. I know if they do a team or they have like a firm that they use, that you can ask all those kind of questions to see what's suitable for for your industry and your job, I suppose.
Yeah. Okay. Now, just while we're on salary sac, because the question just came through, with salary sacrifice, when you have a reportable employer fringe benefits, how does it affect your tax? That's a good question. Annette?
Well, a reportable fringe benefit doesn't affect your tax per se, but what it can affect is your benefits that you may be receiving from the government. It might affect your family tax benefit. It affects calculations in relation to offsets, etc. Because what they do is that, for these calculations for your government benefits and things like that, they take your taxable income, but then they also add your reportable fringe benefits amount along with some other, various calculations, and then determine based on the total amount what you're entitled to for your government benefits or what you're entitled to for various offsets in your tax return. So you don't pay tax on it, but it can affect your end position in relation to government benefits and also tax offsets. Okay,
thanks. As we started with, this can get complex, this one, and people can really go down the wrong track. We won't go into it, but we have shared where people start self-sacrificing on the wrong areas, on the wrong advice, and can affect them, and it's hard to unwind. Okay, next one is also one that people like to ask lots of questions. Kilometres travelled, work travel, how do we keep logbooks? What do we got to address there? Not much of it happening in the past financial year. If we could go back one slide, please, Stella. because of the COVID, obviously not many people traveling. And we're just going, there we go. Kilometres travel. What should we be looking at here, ladies?
Well, Kat, I'll take this one. So obviously with the past year, you know, we might not have been requiring to travel so much for work with our vehicle. A lot of people were, you know, working from home or restricted with their travel, or, you know, in lockdowns, etc. But where you are required to use your motor vehicle for work, and that's not just to get to and from work, but to travel during the day for work or to travel away, you know, in your vehicle for work, then you can claim a deduction. There's two methods that are the main methods. One is the cents per kilometre method. With that one, you need to keep basically a record of all the kilometres that you travel for work. And that's just a fixed rate. So the total amount of your work-related kilometres multiplied by the fixed rate gives you a deduction. The other method is what we call the logbook method. That requires a little bit more record keeping, but sometimes if you do a lot of travel for work and you use your motor vehicle excessively for that work, the logbook method can give you a higher deduction, and it requires you to keep a logbook of all your vehicle travel for 12 consecutive weeks, broken down between what travel is for work and what travel is for private. That gives you a percentage of what your travel is for work, and then that percentage, say it comes to 75%, you can claim 75% of all your running costs on your vehicles. So if you only do a small amount of motor vehicle travel and use your vehicle for work, you know, the cents per kilometre might be the best way to go. But if your travel really is creeping up there, then the logbook is the way to go. It just means a bit more record keeping and a little bit more effort, but it would be worth it at the end.
Thanks. Can I clarify that no one gets to 100%?
Yeah. In any work related expenses, the ATO's position is always there's no way it could be 100% when we're talking about things like, you know, mobile phones and internet use and motor vehicle travel, unless you can sit there and say that you have two cars, one's only used for work and the other one's used for private travel.
You're going to get that question now and then. There's a couple of Matthew just sent through a reminder regarding salary sacrifice for Medicare, and Hex, I believe Annette covered that off before she finished, and another one around car leases with salary sacrifice. I believe Annette covered that off as well before we finished onto those, so we can move on. Thank you, Stella. If we can move on to the next slide, please. Thank you. Home office expenses. Again, we spoke about this a lot. This is becoming more apparent. Lots of people working from home. Kat's done it for 2 years and is the subject matter expert and has some good insights to hear what does and doesn't work. Kat, I'll leave this one with you. You had some really great stories earlier.
I don't know if it's if I'm the expert on, like, it's more just I'm probably more stingy than most people.
You've got a spreadsheet that maps
I do have a spreadsheet.
3 alternate options. That's fantastic.
Yeah.
This is an expert that follows her own advice. I love it, and has experimented with it.
Yeah, so I suppose I know the hot topic last year, or you know, was the ATO was so generous, and then they increased the home office hourly rate from 52 cents an hour to 80 cents an hour. But the difference with that one and the 52 cents. So if you're not familiar with this, is if you did some work from home, there was a set rate that you can calculate based on, you know, your hours worked at home over the year. Times by the set rate per hour. Now, the old rate, I'll say the old rate, it still exists, obviously. The 52 cents is still an option, and basically that is your electricity and your gas. So kind of like your operating costs to have your lights on and, you know, have a computer on and be able to work. The 80 cents, though, which they were being so, you know, generous, like, here we go, you know, COVID, we're helping you out. I think they're a little bit cheeky, because with that rate, that actually includes a lot more than just the operating costs. So it actually includes, and correct me if I'm wrong, Annette, but it includes your mobile phone, your telephone costs, electricity and gas, and maybe a couple more. Annette will correct me. So sometimes it wasn't actually doing better for you. Yes, Paul is right. I did do the calculations. So again, I've worked from home for 2.5 years now. So when that rate came out, I was very interested. So I did the calculation based on 52 cents. I did the calculation based on 80 cents. And then obviously that I didn't include any deductions for my phone or internet. And I also then did a percentage based on my actual bills. Now that last one, you have to be really careful how you work that out. So we won't go into too much detail with that. That is definitely a question to ask your accountant. Yeah, I worked out that the 80 cents was always less favorable in a case where you have got, your telephone and internet costs. If you're only doing a little bit of work from home, or if it was, just during that little period of lockdown, I said little period, it went on for so long, didn't it? But it might work for you. So, again, ask the question, do the sums. Your accountant will help you out with that anyway, claim what is best. But yeah, just be mindful of it, I suppose.
The same thing we spoke about right at the start. There's so many options that have knock-on effects. But every strategy we've spoken about today actually links with the next one. So none of these in isolation will give you the full impact or the full benefit without having a wider discussion, and then including your cash flow and your investment. So the next couple that we want to cover: income protection, tax deductible. Annette, would you expand? Is there anything to expand on that? That's pretty self-explanatory?
It's very straightforward. If you take out income protection in your own name, so not through your super, but in your own name, the policy, the premium is deductible. If it's bundled with other insurance, you've got to be careful. You need to make sure it's split out, and it's only the income protection portion that you're claiming a deduction for. People of working age, income protection is something that, is worthwhile having a look at. If you have an injury or an illness, have you got enough money to get you through for the next month or, couple of months or couple of years, without having some sort of protection? And that's the thing, your mortgage isn't going to stop, your rent's not going to stop. So, sometimes these things are worthwhile looking at, and the premium cost is a deduction.
Yeah, good point. I'll just expand into that. Any risk or insurance discussions for yourselves, please seek professional advice. They have enormous impact. How they're funded, who owns them, how you receive the benefits are wide ranging, including it does have an effect on your super fund. So please make no changes until you speak to a professional and get appropriate research and analysis done on your current situation and your future situation on a full spectrum of your insurance needs. Please don't make any changes, and that includes swapping your super funds for what seems to be different benefits. Believe it or not, your super funds most of them have some form of compulsory insurance in there, and you can put yourself at risk by not exploring those further. Which leads us to our next point: exploring further investment opportunities. There's other ways to save tax. You can make more money. So spending $1 to save 30 cents versus making more money is a really good approach to make more money. And as Annette and Kat said before, you can actually increase your tax deductions there. Kat, do you want to lead off on this one with investment opportunities as a tax strategy? Making money as a tax strategy is a fantastic way.
Yeah, so there's a lot of investments out there, and especially in this digital age that we're in, there's new ones every year that's really fun for us accountants to try and keep on top of. And it's it was funny because cryptocurrency was the untaxable money, but now we're taxing it. So
can I be clear that cryptocurrency is not an investment? It is speculation. It is a gamble and remains that way for some time.
It is a gamble. Well, I think that's a really good word to use. It is a gamble. So are all investments. So that's why it's really good to have a really good relationship with professionals, because they know a little bit more than the average Joe Blow. So yes, it is. I would say it is a bit of a gamble. Whenever you're investing your money, whether it's you're buying a car or buying a house or whatever it is that you're doing with your money, but investments that can assist with your tax. We won't go obviously into too much detail with all of them. But investment properties are really favorable one for a lot of people. Shares. I suppose what I would say, if you are looking into doing that, is obviously have a chat, see where your money is best suited for you. Again, it also depends on your age and your risk appetite. Whether you want to be quite conservative or if you want to go all guns blazing. So that all depends again of your lifestyle stage, I suppose. Just seek professional advice, I'd say, with this one, because it is one that if you do it without chatting to your accountant or your financial planner. I have had a few clients in the past come to me, new clients, and they've, I've got another property in my name, but I don't have any documents for it. If you are doing investments, it is like tax, it is taxable. So you need to make sure you keep the right records, and you're doing the right things to make sure that it is as beneficial as it can be for you.
Absolutely. Annette, did you want to expand on that?
Yeah, I just back up what Kat said. If you are open to investments for a tax strategy, the first thing you should do is go speak to your professional advisors, because not every investment fits everybody. There's, the wealth side of it, you're, making sure it's aligned with your personal goals and your personal circumstances, and also, the income side of it and how it's going to affect you with your tax position, etc. It's good to look at these things, but really before you jump in and take a chance, it is best to speak to someone to make sure that what you're looking at is best aligned with your circumstances and your goals.
Yeah, correct. I think in terms of talking tax minimisation, the definition of the word investment is to make a return, in other words, make money. So it should be available. The fact it's tax deductible is even better. But the two middle points there is it should be linked to a long-term strategy, personally, and linked to goals, and requires detailed planning and analysis. Neither of those mention a product or a type of investment, but those two things are the most important thing. Link it to a long-term strategy, make it over time, and make sure you've got detailed analysis so you're making educated choices. The investment will fall out of the end of that discussion, which is really good. Yeah. So a great approach.
And okay. I think with that, just quickly as well, is what we were talking on super before, and super is always a hot topic with the getting a tax deduction. But that is very long-term strategy. If you're in your 20s or your 30s, or you don't want to, or you can't retire until you're like 75 these days. There may be other better tax strategies and investments that you can use with your money. But yeah, obviously the better strategies, as Paul said, is the longer term ones, because it makes you more money.
Yeah, you're absolutely right. It's a good delineation you just made, Kat. Super is an investment strategy as well. So it should be actively approached as well as tax minimisation. Okay, thank you, guys. There's some great strategies there. Lots we've spoken about in the past, but we spoke a little bit more about details. If they did hit home with anyone, or they'd like to talk more, we have got a couple of questions I'll cover off momentarily, but please reach out to your professionals, because they, as we said before, they do link to each other. Let's move on now, please, Stella. Let's talk a little bit about how do the financially successful maximise tax time. What do they do at tax time in preparation? How do they make the most of meeting with their account professional? Annette, do you want to talk a bit about this to start with, please?
Well, yes, with this one, it's take action and be prepared. And what it is when you've got a meeting set up with your accountant to look at your tax, just don't throw all your documents in a folder and turn up and think that, it's all good. Take the time to think about, where your goals are at, what's keeping you up at night in relation to your tax or your financial position, and come prepared with these sort of questions and these issues and concerns that you have, so that, we can discuss your tax on a broader level, not just, have you got a receipt for this, or what deduction do you want to claim against your tax for that. So yeah, be prepared, take action, and think about what else you would want to get out of your accountant in relation to your personal circumstances.
Yeah, there's some of that involved doing some planning during the year, reaching out during the year, and having some long-term strategy approach to it.
Yeah. It doesn't need to be left to the end of the year. It can actually be starting from the very next tax year and planning ahead, looking forward, not just looking back. And sometimes I think we get into a situation where we are, for the tax side of things, looking backwards, but it doesn't hurt to look forwards.
Yeah. Proactive is always better than reactive. Kat, did you have any additional information there?
I think what Annette just said, I think, is probably the most perfect one. Now, I consider myself young. I'm 31, so I think I'm still a bit young. So I'm just using me as an example because I think, that's always the best one. But thinking of the bigger picture. So again, people think of tax time as just what happened last year, like Annette said, but if there's something that you might not be able to do now, like because you can't afford it yet, or it's too late to do it because it's past 30 June, it's asking the questions that help you in 20 years time as well, and putting in the plans to act on that now. I was really naive when I first started working, and I didn't think income protection was something that someone who was employed needed, because I'm always going to have a job. You know what I mean? But, like you said, it's for those circumstances where you might be, out of work if you're unwell for an extended period of time or something like that. So just those little nuggets of gold, I suppose, that you can pick up just for asking certain questions that, even if you're interested in, I want to have a share portfolio by the time I'm 50 or whatever, asking those questions now doesn't necessarily mean you need to implement them tomorrow. But you can work towards implementing them sooner than maybe what you thought you could.
Yeah. I think in summary, you both touched on it, but really from the things you've told me over the years, it's the most successful come at tax time and prepare early for tax time to link to their financial goals. They have a reason for coming to see you guys and girls, and it's not about minimizing tax, it's about achieving and reaching financial goals and working towards it. Okay, thanks guys. One more question is, what do the financially successful ask their accountant at tax time? This is where they put the pressure on you guys. What should we be coming and asking our accountants? And it's not, can I get 100% right off of my car? Because you always tell me no. I ask it. What else can we ask?
I'll go first if that one is okay, Annette. I don't want to talk over anyone else today. Well, I want to just say, financially successful. So I read that, and sometimes you think, oh, I've got to earn over 100,000 or the 6-digit figure. Financially successful comes at any type of wage. It doesn't necessarily mean how many dollars hit your bank account from your employer. It is just that proactive thinking, and they're the kind of people that become obviously financially successful. So when it comes to asking the questions, like we said on the previous slide, it's just ask the question. So I would say that the financially successful ones aren't really the ones that ask about the year just gone. They ask about their personal goals, their personal finances. So, their personal goals could be, personal finance, a bit strapped for cash at the moment because my mortgage is so huge. So the question then would be, okay, well, what can we do to help minimize that mortgage so that you can have, a little less of a burden each month or however often you pay your mortgage. So they're the kind of, I think, financially successful questions that get asked at tax time is, what can I do better next year or in future years?
Yeah, great. Good idea, Kat. Annette?
Yeah, I would agree with what Kat said. That's absolutely what anybody should be thinking about when they see their accountant. And as you said, financially successful, that could be making sure that you're managing to pay the school fees and the mortgage and have a little bit left over for, your own lifestyle, and entertainment. But it's basically what can you do going forward? So it can be a review process. Yes, look backwards. Yes, have a look and get together what records you have for the past year, but also what can you do and what record keeping requirements, documentation and things do you need to improve on going forward to assist you with not only your tax but your financial, strategies as well. So it's both looking forward and just addressing the past and what you can improve on that, and how you can improve on that.
Yeah, thanks, guys. I think proactive is the key in what you're saying. I like the fact that personalised, you're thinking about the future and asking what can I do more. Something that I always see working really well is adding to all those personal, being proactive, having your records appropriately, being organised, is also making them very much personal, goal related, but putting a time frame and a dollar value to them. If you can put those variables to your tax account, they can actually start to work with facts and figures. And for the clients, you can start to get facts and figures back and make educated choices. So make them personal, make them goal orientated for yourselves, put a time frame around them and a dollar figure. And then the next question to ask, I believe, to ask yourself, the successful people ask themselves before they come to tax time is, what are the implications of me not doing this? And what are the implications of me doing it? So does it really mean, and does it mean I'm going to achieve things and give me motivation? And then ask the same questions of the accountants, because it will identify missed opportunities. So the implications of doing something and the implications of not doing something have very different approach and can really affect the way you address your goals. So they're my suggestions. I think they work really nicely with what the ladies have said. Okay, let's open up to some questions. We've got a few popping through now, and I'm just going to pull them up on my screen. Thank you for everybody who sent them through. We've tried our best to answer most of them as we've worked along. We have got a couple more. I'll start at the top. Kat, does any work test apply for concessional contributions?
You always pick on me.
You're at the top of my screen. You're just at the top. I can go to it now.
No. So with anything, and I know it sounds like we're beating a drum here, but everyone's situation is different. So there's not just work tests, but there's also age tests in relation to these concessional contributions. There's also how much you already have in your super fund that can be impacting what you can and can't contribute as well. So yes, to answer your question directly, yes, there are work tests. I think it's something like 40 hours. Ooh, I don't think it's 40 hours a week. I think it's 40 hours a fortnight or something. 40 hours, a 30-day period. There you go, 40 hours a month. And then if you've got that, then yes, you can contribute.
Yeah.
But like I said, everywhere, just always ask the question based on your own personal circumstance.
Yeah.
And what you're trying to achieve, which I think will answer the next one too. Annette, you'll probably say the same thing. Is a tax offset better than a tax deduction?
Theme of the day, it depends. But I mean, a tax deduction reduces your taxable income. Anytime you reduce your taxable income, you're obviously going to reduce the tax payable on that income. So a deduction, it is very good. It is probably more preferable than an offset. And offset's just something that flows out once you have, prepared and determined what your taxable income is and what offsets you are, eligible for. But the deduction reduces the taxable income, which reduces your tax. So that's always going to be a preferable thing to do.
Yeah. Okay.
Yeah, and I suppose with that one as well is tax deductions, like as long as they're eligible tax deductions, they're guaranteed, aren't they? Whereas offsets depend on all different things, and a lot of them are non-refundable, which means that unless you meet the criteria, you don't get the money if you haven't paid the tax anyway. So yeah, I think I feel like we always dodge. It sounds like we dodge questions, because we're like, it depends on your circumstance. But that is the beauty of tax, I suppose. It does depend on your circumstance. So.
Yeah. Only an accountant would find beauty in tax. That's true, though. Okay, Annette, here's one for you. Cents per kilometre method. If I have two cars and I use both for work, can I claim 5,000 kilometres for each?
The short answer is yes.
Okay.
You can, as long as you use both cars, as long as you have actually traveled 5,000 kilometres or more for work trips in both those cars, and you've kept the appropriate records for both those cars, then you can.
Absolutely. Thank you. Can we claim, oh, here you go. This one's definitely for you, Kat. Can we claim home insurance and rates, etc., when we're working from home? That would have been on your spreadsheet.
Well, yes. Again, this depends on your own circumstance. If you own the home, you obviously have the rates. Look, it depends on how often you do work from home. So if it was just that COVID period, it's probably not beneficial to you to claim the rates. And look, Annette might have a different opinion, Paul might, but claiming rates and interest and stuff like that, it makes your home go into capital gains. And it might be only a small amount, a small portion, but basically when and if you sell your primary residence, which is usually tax-free, if you've claimed things like rates in your tax return, you do have to claim a portion of that in the capital gains calculation. So something that normally you wouldn't even worry about, you do have to worry about. So we normally advise against doing those.
Okay, well, that's a good point. It's another example of a knock-on effect, trying to claim a tax deduction. Yes. Okay, Jeffrey's asked for a copy of the presentation. Of course, all of our presentations are online. You will receive communication after this, telling you how to get those. So absolutely, everyone gets this, along with, we've got a massive library of information and videos and stuff like that. So absolutely available. Last question, how do we reduce capital gains tax?
That's very ominous. Like that's a huge question.
The easy one is make less gain, but no one wants that. So there are lots of strategies, but that starts to get, again, very complex depending on where you are.
Yeah.
I'd say the answer to that is pick up the phone and speak to your RJ Sanderson and Madoris expert, because it will have big implications. And
absolutely.
Yeah.
You don't want to make less gain. Make much as you can, and we'll work the rest out later.
Yeah. But also, I think what can reduce it is talk to your accountant before you sell it.
Right.
Sometimes I have so many people. Again, the biggest one obviously is usually investment properties, and they just sell them when they feel like it, and they don't really understand the effect that has. I think people are getting more and more educated these days, obviously, so it's happening less and less. But certainly, at the start of my career, I was finding so many people that just had no idea of the implications of selling this kind of stuff. And capital gains tax is a huge amount of that can impact your taxable income. So like we had on the slides before, and like Paul said, is usually they're longer term strategies, and usually it's and again, I'm saying usually a lot, aren't I? It's you get rid of these investments when you have a smaller taxable income. Again, usually it's all different circumstances, and again, if it comes to a different time of your life where you need to access and liquidate that, then that's obviously different. But if you don't need to do it, it's always best to have a chat and see what you can do to make sure that your taxable income is less.
Can I suggest one better than you spoke about? Speak to your accountant before you sell it. Can I suggest you speak to your accountant and your advisor at the same time in the same meeting before you buy it, and set your structure up early?
Yes. Structure's good there, Paul. I think that's the key word, is the structure. Yeah.
Get that sorted prior to any investment. Not only will you have a better capital gains result, but you will have a better cash flow, a better income, and a better growth result that will link specifically to your wider goals. So speak to your team before would be my best discussion there, or best thought there. Okay, thank you, everybody. We'll move on very quickly. For everybody online today, as always, our gift to you is please pick up the phone. Our team is ready and waiting to help you, and very happy to have a phone call and start to talk about these things and guide you in the right direction to achieve your goals. Thank you.
I think we just had one more question come through, Paul, if you wanted to.
Oh, did we?
Yeah.
Oh, there we go. Someone got in last. Oh, can we offset capital gains against other losses?
Well,
So yeah, Annette, if you want to answer it, you can.
well, it depends what you mean by other losses. Is
Okay.
it capital losses? Is it tax losses? Is it non-commercial losses? So once again, it's very broad, but if you have capital losses, absolutely you can, offset them against a capital gain, and then it depends on the other losses that you're talking about, what the situation is, and pick up a phone.
Yeah. And in what entity structure again?
Yeah.
Okay. Thank you very much, Kat and Annette. I really appreciate that. Roy's coming with an answer there. Thanks, Roy. Not normal business or trading losses. So yeah, I think we're going to speak to our professionals for that. Annette and Kat, thank you for your insights. Fantastic. Love having you on our webinars. For everybody at home, there's more webinars to come. We very much love engaging with our clients. If you do have any ideas or topics you'd like us to discuss further or put more webinars over, please, again, pick up the phone, drop us an email. We love getting feedback. We love getting questions, and we love making it very personal for you guys and girls at home. So keep an eye on your inbox. As always, stay safe, and please remember, if anything did touch a nerve today, pick up the phone. We're here to help. Thank you, Kat. Thank you, Annette. Thank you behind the scenes for Emily, Jolene, Stella, and Charles. And of course, most of all, thank you to everybody at home or at work watching this. Have a great day all. Cheers.
Thank you, Paul.
Thank you.